Howdy y'all, welcome back. I'm Raymond Dahlman and this is the weekly wrap-up for June 4th, 2021. I hope everyone had a fantastic week. It's been a little warm here in Colorado. It's been up in the high 70s, low 80s here. Granted, I'm only at about 7,000 feet, so that's not quite as high up as, like Evergreen or Conifer or a little further west. So anyways, I hope everyone had a good week. I hope the weather down in Texas, where most of y'all are at, is fantastic. It's probably a little humid this time of year. Let's see. We had a holiday on Monday. I hope everyone took some time to think about those who've been sacrificed by our government. And the rest of the week been kind of up and down. Seems like some little bit of bad news, a little bit of good news. So. All right, well, let's go ahead and dive into the market and see how that has been doing this week. So the Dow Jones looks like this week was up about 0.64%, so not too bad. Had a little bit of a dip here. Looks like Wednesday morning. But all in all, not too bad of a week. The S&P 500 looks like it was up about 0.4%, so again about a 0.5% there. NASDAQ had kind of an ugly week. Looks like we started out, it was up for about a total of 0.38, but again midweek was kind of ugly. And so the Dow Utilities, let's see how that did. Looks like it was fairly flat, 0.15, and then the Dow Transports looks like they were down for the week about 1.78. Let's take a look at some commodities. Gold for the week looks like it was down a smidge, down to about 1891 at the close today. Looks like it got up as high as in the 1900s an ounce. Silver looks like a very similar chart. Looks like it was down about a 0.5%. And then Bitcoin, it's since it slid back a few weeks ago, it's been slowly climbing up towards 40,000 an ounce when things closed here today. Looks like it closed at around 36.8. So we'll see where that goes over the weekend. But that's the major indexes. We'll take a look on Monday and see how the rest of them did. All right, well, let's take a look at the jobs numbers for the week. Initial jobless claims came in at 385,000. Forecast was 390. Let's take a look back and see last week's numbers were revised down from 406 to 405. So again, that's some that is some bright spots. We're under 400,000 in jobless claims. For the first time in quite a while, since before this whole COVID nonsense got started. Let's take a look at continuing jobless claims. They came in at 3,771,000 against a forecast of 3.615. So a little worse. Again, not terrible. Last week's numbers were revised up from 3.642 million to 3.738 million. Again, very close to where we're at today. But it does appear that it's kind of leveled out. Just looking here back historically, for the last, since really the beginning of April, we've been just under 4 million continuing jobless claims. All right, non-farm payrolls. This came out this morning. We had an actual of 559,000. New jobs created against a forecast goal of 650,000. Last month's numbers were 266 and were revised up to 278. But again, both of these have missed the mark by quite a bit the last 2 months. This month, not nearly as bad, about 100,000. But last month's was just terrible. So. And then the last chart, as far as employment, I wanted to look at was the labor participation rate. Came in at 61.6%. Last month so it actually dropped from last month at 61.7 down to 61.6. So, I'd call that flat. But that, if you look back here at the previous historical numbers, I mean, we've been, let's see, going back to like July of last year, we've been at or above 61% for basically that whole time. And then prior to the meltdown we were in the 62-63% range. So, I mean, you can see just looking at this chart, from last year to this year, that is granted, it's only about 1.5%, but 1.5% of the entire nation is a lot of people. So there are still a lot of people who are not employed. If I were to put on my or stroke my beard of knowledge and make an educated guess, I'd say it probably has a lot to do with people who are collecting benefits rather than working. So I know I'm hearing a lot from on the TV, the news outlets I listen to, and just out and about. I see a lot of help wanted signs out there, and jobs are just not getting filled. So, anyways, that leads me to what I want to talk about a little bit here. The inflation that we're experiencing. I've been to the grocery store twice this week, and it's like at least 30% more than what I would expect under normal times. And I mean, a lot of this boils down to just a lot of the money creation that we've had over the last 12 months. I had been referencing the M1 money supply, and how that chart just jumped last year. Granted, I will add in that they have started calculating that number differently, so I'm not going to use the M1 money supply anymore. I'm going to go ahead and moving forward just use M2. M2 takes into account savings and things that aren't just your regular checking accounts. So this will give us a more accurate number of what the supply change over the last year. And looking back a year ago, well, I guess about 15 months, in February of 2020, the money supply was at 15.473, and then today, as of April's numbers, they came out. We're at 20.108 trillion. So that's about just under 5 trillion that has been added to the money supply over the last year. That's going to have a lot to do with purchases that we make at the grocery store, buying gas. Lumber is one of those things that has just gone through the roof. Maybe on Monday I will take a look at the different consumables and their prices. That I'll try to get that together and talk about that a little on Monday. So again, the money supply has drastically increased. Just to kind of a comparison. Back at the end of 2007, before the financial crisis that we had, a decade ago, we went from 7.471 trillion. By the end of the recession, we were at 8.45. So I mean, that's about $1 trillion was added over that. Was that about a year and a half's time? And we've basically done 3 to 4 times that just in this year. So again, it does something that is something that gives me a little bit of pause. All right, well, I'm gonna go ahead and talk about 3 different articles that I had flagged this week to share with you guys. And the first one is by Lou Rockwell himself, Myths of the Mixed Economy. And I'll just start out and read a couple of pieces from this. Starts out, the planned economy was all the rage in 1937 when Prentice Hall published a 1,000-page tome on the planned society, yesterday, today, and tomorrow, a symposium by 35 economists, sociologists, and statesmen. The question that confronts us today is, if not we shall plan, but how we shall plan, wrote Lewis Mumford in the foreword. All contributors, Keynesian, socialists, communists, and fascists agreed with that point, including such luminaries as Sidney Hook, Benito Mussolini, and Joseph Stalin. But the book was honest. It linked Stalin and Keynes, fascism, and the New Deal. The plans are not identical, of course, but all agreed that the government rationality on government rationality as versus the chaos of the free market. And then there was one last bit. Where is it here? Basically, let's see here. If the mixed, this is the last paragraph. If the mixed economy is such a disaster, why do we have one? Because it enables the well-connected to loot the rest of us in a social democracy, disguising it as democratic capitalism. To get away with looting, the mixed economy state attacks all countervailing institutions, families, neighborhoods, businesses, private schools, and charitable and religious organizations. The result is barbarism and increasing poverty we see all around us. He originally published this back in September of 2006. So, I mean, we're nearly 15 years from that point. So, I, as a libertarian, I like a free economy. I think that's the best way to do it. Anytime the government's involved, you're picking winners and losers. And I think it's fair to say that the U.S. federal government is a shit show that doesn't seem to accomplish a whole lot other than robbing the populace. All right. Second article also is on LouRockwell.com this week. It's from June 3rd, which was yesterday. Biden and the Fed are creating an inflation crisis. This is by Robert Luddy of the American Spectator. Let's see here. The Federal Reserve Bank and the Biden administration are systematically undermining the ability of the American economy with a variety of unwise and destructive policies. The Fed and the administration defend these policies by which denying obvious economic truths, which include their own inflation data. Treasury Secretary Yellen asserts that that inflation is transitory and shortages are temporary. More than 300 manufacturers have asked President Biden or the Biden administration to end disruptive tariffs and to ease shortages and reduce costs. And one of the examples here is galvanized steel has doubled in price and is only sold on allocation, resulting in a severe shortage. Steel in the EU is 40% lower in cost, which provides huge advantages to our EU competitors. The HVAC industry is experiencing the worst inflation since the mid-70s. And all right. According to this gentleman, he believes that Jerome Powell is the worst Fed chair since Arthur Burns from 70 to 78, who created massive inflation with his policies and arrogance. Burns denied hard factual data, and now Powell is following in his footsteps by doing the following. Powell's Fed initially contracted the Fed balance sheet, but reversed course and began to buy government and other securities at a rate of $150 billion per month. The balance sheet has expanded from 4 to 7.4 trillion over this period of time. I know I've talked about this. How during the first few years of Trump's administration, they were selling off assets on the Fed's balance sheet, bringing that number down. I know they were doing it slowly, trying to avoid any sort of flooding the market with certain securities that would create some price fluctuations. But since things went to hell over a year ago, that went out the window, and we've been adding a ton of money to the balance sheet of the Fed over this period of time. Let's see. The impact of these purchases is to destroy market pricing of interest rates. The next bullet point, short-term interest rates are near zero, which denies savers any return and forces speculative investments, undermining orderly, rational markets. This is something that definitely has been an irritant for me for really the better part of more than a decade. When I first started in this business, in the mid-aughts, you could get 3-4%, in savings accounts, CDs, things like that. So the money that you wanted to keep safe, you could actually make something on it. I know I had I think I had a money market account at, I believe, ING at the time, and it was paying like 4 or 5%. So today, those rates are, gone. And then the worst Fed policy is their promotion of 2% inflation, which undermines the buying power of the lowest income workers. This policy is cruel and stupid. Once inflation begins, it's difficult to arrest. Paul Volcker tamed inflation in the 80s, but very high interest rates crushed economic growth. Granted, I was a little kid back then. I really, I remember, the consequences, seeing the consequences of that. Gas lines and prices, changing or getting quite large, over a short period of time. And here's his solution. The following solutions will be difficult but necessary to achieve stable prices and economic growth. Immediately eliminate tariffs on steel, electronics, and lumber. Unilateral free trade is the best solution for low prices and high quality. Stop Congress from passing any new trillion-dollar spending bills and using borrowed money. End the obsession with false god, man-made climate change, and let the market create energy efficiencies. I think that's probably a good idea. End deficit spending with the fiscal year 2022 budget, which will reduce the footprint of the federal government and make the Fed discontinue purchasing bonds and let the market determine short and long-term interest rates. So, all good solutions. I'll attach this in the show notes, so you're welcome to read the entire article. And then the last one I wanted to share was from Walter Block. I think he teaches at Tulane, maybe. I know he's in the New Orleans area. And this article is Bernie Sanders' case for raising the minimum wage falls apart. And Walter, I believe, and he talked about this here in this first paragraph, I believe he went to high school with Bernie Sanders. So it starts out, quote, in my view, when it all comes down to this. Are you on the side of the working people in America who desperately need a raise, or are you on the side of the wealthy and the powerful who want to continue exploiting their workers and paying starvation wages? It ain't more complicated than that. So that's Mr. Sanders' quote, and he says, this is a comment from my high school fellow track team buddy, the junior senator from Vermont. But he does say that Bernie Sanders is wrong. It's quite a bit more complicated than that. If it were simply why do advocates of this pernicious legislation merely call for a stinking lousy cheapskate $15 per hour? Wouldn't an hourly 25 or 50 or 150 show even more support for the working class? So, and that's an argument I've heard a lot from my libertarian friends that, why 15 an hour? Why not 100? Why not $1 million an hour? I mean, but anyone who's run a P&L knows that that's not how business works. You pay people what they're worth to you, and that other person decides that is in a voluntary society that's the wage that they're worth working for. Government setting wages really does nothing more than create inflation and push prices up. So I think, what was it, the last paragraph? See, Bernie doesn't seem to realize that before the advent of vicious legislation in the 1930s, the unemployment rate of whites and blacks, youngsters and middle-aged was about equal. All were within a few points of each other, but due to the minimum wage laws, the unemployment rate of teens is double that of adults, and blacks suffer twice the rate of unemployment as whites. Black young people suffer from quadruple the unemployment rate of middle-aged whites. So, again, I truly believe that anytime you have the government involved in something, it's certainly going to create bad outcomes. And just by allowing people to work for what they want to work for, and employers to pay what they deem is an appropriate price, odds are your best way to handle the economy. So again, I'll share this with y'all, and if you have any questions or concerns, feel free to give me a call or shoot me an email. Be sure to like, subscribe, and share with your friends. I would greatly appreciate it. And hope everyone has a fantastic weekend. I'll be back on Monday with the economic update and any news that big stories that occur over the weekend. So have a great weekend, and I'll talk to you on Monday. Bye-bye.